So the last trading day has pretty much captured the essence of 2018. No bumper returns for investors, but it has been an eventful year for the last trade. Compared to other global and emerging markets, India has shown a lot of resilience. Nigel D'Souza is here with a wrap. Nigel, you've been doing this every year. How do we stack up versus emerging geographies?
Well, 2018, yes, it was a bit of a year of consolidation because you're looking at the headline markets and you look at the mother markets, that's the United States and some of those European indices, they are sitting with cuts of around 7% to around 18% odd. But if you look at the emerging markets, well, the Brazilian index, that did very, very well. So that was up close to around 15% odd, while the Indian markets as well, relative outperformers in comparison to what happened in Russia as well as the Shanghai market, we were up roughly around 3%, while the Chinese market was trading at fresh 4-year lows, or that lost close to around 20% in the past year or so. But let's get straight to the Sensex. The Sensex did well. So in rupee terms, you'll say, well, we did well. We were up close to around 6%. But in dollar terms, keeping in mind that the Indian rupee moved from around that 64, 65 odd mark all the way to the 70 odd mark. In dollar terms, the Sensex was down close to around 3% odd. But let's get straight to the big indices and what did very, very well. The IT index as well as the Nifty Bank, both of them backbones of the Nifty, they gave you returns of around 6% to around 24%. But otherwise, there was pain in the broader markets, both the small cap and the mid cap space. We did see cuts of around 10 to around 20%. But quickly moving forward then, if we're looking at the IT index, it did well, I told you. It was up more than 20%. Some of those stocks in there did very, very well. Namely, Tech Mahindra, Infosys as well as TCS, all of them gave you big returns. But it wasn't just these stocks. Some of those heavyweight stocks in there, ICICI Bank, HDFC, both of them put on weight. And even Reliance Industries is up more than 20%. And if you're looking at these top 5 stocks, they constitute more than 30% of the index. When they move up by around 15 to around 20%, that's telling you that they did the heavy lifting in the past year or so. Other winners include the likes of Bajaj Finance, that was up close to around 50%. Hindustan Unilever as well did pretty well in the last year or so. But there were some losers as well. And Tata Motors, that finds a mention in there. That was down more than 60% in this past year. And Yes Bank, plenty of issues cropped up. That stock was down close to around 40% in the past year or so. But moving to the broader markets then, and let's see how those stocks fared in there. Large cap IT did well, right? Some of those mid cap IT stocks, NIT in there with good returns. You have Mindtree as well in there. And it wasn't just the IT names. Some of those consumption names as well did pretty well. So Nestle finds a mention in there. United Breweries as well, chugging some beers in there. As well as Britannia, up more than 20% in the past year. But ending up though, from the broader markets, we had some pain. PC Jewelers is down 80% from the top. Jet Airways as well did see a lot of erosion in terms of market capitalization. And even JP Associates was under some pressure. So to sum things up, this was basically a year of consolidation. 2018, in rupee terms, yes, we were higher. But in dollar terms, that's what FIs look at. We were lower actually in 2018 itself.
All right, well summed up. Thank you, Nigel, for joining in with that. So 2018 has been a fairly subdued year for equities. But what does 2019 have in store? Sonia Shenoy has been collating various brokerage reports and she's joining in now with more details. Sonia, what's the outlook that brokerages hold for 2019 at the equities market?
Well, most brokerages are quite bullish in 2019. They believe that there is more upside than downside in the Indian markets. Morgan Stanley has a target of 42,000 on the Sensex by the end of the year. They also have a 25% upside that they've predicted for the rupee and a 7% upside on the MSCI Emerging Market Index. They are bullish on a couple of themes. One theme is companies that have incurred capex over the last 5 years will reap the rewards in 2019, and Reliance Industries is their top bet in that space. Apart from that, they believe that companies with rising return on capital employed like Asian Paints and Titan will continue to do well. Companies with an earnings revision like M&M Finance, and also companies that are growing at a reasonable price like Bajaj Auto, HDFC Bank and ITC top their charts for 2019. Apart from that, Credit Suisse says that the election outcome will not impact markets whichever way it goes. They think that the investment cycle pickup is likely to sustain, so they are very bullish on the capital goods space. They say that a big boost in consumption is unlikely, so they prefer investments over consumption. They prefer capital goods over the consumer staple stocks. Their top picks are L&T, BHEL, SBI and ICICI Bank, while their least preferred picks are Ultratech Cement and HUL.
All right, Sonia, thanks for wrapping that up for us. Let's get some market opinion going as well. Motilal Oswal's Ramdev Agarwal expects Nifty to hit 13,000 to 14,000 in 2019, even if crude oil prices touch the $85 per barrel mark. He in fact added that we might see another year of correction because it takes 2 to 3 years for the market to fully correct from its highs.
When we started the year, there was so much positivity, going into 19, because 18 was such a wonderful year. But if you look a little longer, this 1 year thing, you don't know. You may have another year of correction, because in the past 2 to 3 years have been the real norm. From the highs, typically it takes 2 to 3 years for it to fully correct. Oil may go to 85, and still the index may is still go to 13,000-14,000. So there is no correlation between one factor with other. You have to be very watchful of earnings in the broader market, earnings in the Nifty, and earnings in your own portfolio. So there, I think there is a matter of optimism.
Okay, so that was the outlook on equities. How did various asset classes perform in 2018? What kind of returns did investors get? Manglam Malu is here with that data. Manglam, where was money made really, and what was the overarching theme for the year gone by?
Well, in terms of returns from all asset classes in 2018, two themes really stand out. It was either risk off or flight to safety. If you take a look at the equity investments, which are considered to be more risky of equity, debt, as well as gold and real estate, equity investments, the frontline index, which is considered more safe, saw a 3.5% gain. The Nifty, that is, but slightly riskier instruments, and your wealth would have come off by 15 to 30%, depending on whether you put it in the mid-cap index or the small-cap index. The safety of the 10-year government bond really stood out in 2018 with a gain of nearly 8%, while the safety of the gold also did come off with about 8.7 to 8.8% returns on that yellow metal. What did not do well was the silver metal, which was down by about 1.5%, a bit of sheen robbed of silver itself. If you took a holiday in 2017, saved some dollars from there, you would be higher by about 9.5% on the value of those dollars. That was the sort of depreciation that we saw in the Indian rupee. So the dollar itself gave you about 9.5% returns as well. But if you thought buying a property was cheaper in 2017, you would have gotten 10% cheaper as per the prop equity real estate index. For those who believe that parking money in the mutual funds has been good, in 2018, not so much. Over the long term, perhaps yes, because if you take a look at it, the medium to long duration debt funds have given you about 4.7% returns, as well as the short duration funds have outperformed the long duration funds about 6.1%. But together, they have still underperformed gold as well as the 10-year government bond yield. In terms of balanced funds, which are a mix of both equity and debt, the ones which were a little more aggressive with higher allocation towards equity saw a decline of about 3.1% from the start of this year. And we had the slightly conservative balanced funds, which have a higher exposure to debt and lower one to equity, still would have been flat to mildly negative in 2018. So two words that sum up all asset class returns in 2018: risk off and flight to safety.
Okay, flight to safety indeed. Thanks, Manglam, for taking us through that. But staying with the key asset classes, crude oil prices have ticked higher, but are still hovering near their lowest levels in more than a year. So Brent and NYMEX remain on track for the first yearly decline seen in 3 years. Let's bring in our very own Manisha Gupta to do the number crunching for us. Manisha, after a grim 2018, where are crude prices really heading in 2019?
Oh, well, absolutely. It's actually been a bipolar, the way crude oil has behaved. From Jan to October, you saw the prices gain up by 30%. And from those highs, we've seen prices decline much more than that. This is actually the worst quarterly decline that we have seen for the crude oil prices since 2014. The US crude is down by nearly 38%. For the year, we are down, of course, 25%. And this is the worst year since 2015 as well. So, yes, the declines have come in on the back of record high production from US, Russia, Saudi Arabia. And then, of course, you saw the interest rates continue to being hiked from US. That also led to some concerns. The global demand consumption is expected to slow down in 2019 as well. And then, of course, came in that surprise waivers on the Iran sanctions. That led the prices quite on the weaker side as well. How we are looking at 2019 is with a bit of a consolidation, really, because when you look at the prices, the markets do believe that we are close to bottom, perhaps another couple of dollars down from here on, but you could be looking at some support report. If you look at the prices, we have managed to make a $70 per barrel of average for the Brent prices for this year, and most experts will tell you that that's what we are expecting for the next year as well. So a couple of things to watch out, of course, is going to be the OPEC and allies output cut that would begin from 1st of January 2019. There is going to be a lot of transparency because all the OPEC members and allies are going to publish their output cuts. So the markets will be able to see those numbers exactly. When it comes to a lot of brokerages, while of course the most bearish is Citi, which feels that $57 per barrel is what you could see in crude oil prices in the next year, most brokerages do believe, are of a consensus, that $70 to $72 per barrel of an average is where the Brent prices could be. The most bullish, of course, is ABN AMRO at $90 per barrel, but not too many people believe that the crude oil prices could be hitting that. So a couple of major things to watch, of course, would be the currency play, and then, of course, the US and China trade concerns. Those are a couple of unknowns still as we get into 2019.
You know, Manisha, you started rightly. Bipolar is the word to say for crude oil prices. But thanks for joining in with that. We'll let you go. But let's get to the big macro story of the day. RBI has released the Financial Stability Report. And for the first time in recent memory, the central bank sees non-performing assets easing across banks. But the report also points out that capital could come under strain. Let's go across to Ritu Singh for more details. Ritu, this is Shaktikanta Das's first Financial Stability Report. Take us through the highlights of the report.
Well, the asset quality pressures finally may just have peaked. That is according to the Reserve Bank of India's Financial Stability Report that has just been released. In the words of RBI Governor Shaktikanta Das, after a prolonged period of stress, the banking sector finally appears to be on a course to recovery. The first half-yearly decline in gross NPA ratio since September 2015, as well as an improving provisioning coverage ratio, augurs well for the sector. In his words, the stress test results suggest a declining trend in the NPAs, which is a positive sign. Although he says the current level of asset quality pain that remains fairly elevated, but enhanced recognition of asset quality stress by public sector banks is something that will ensure greater discipline in credit assessment. He also says the IBC has bridged an important institutional gap to strengthen the much needed credit discipline in the system. But that said, the most important factor is the stress tests that the RBI conducts in the Financial Stability Report, where the data or the results are finally released. According to this, under the baseline scenario, the gross NPA ratio of all scheduled commercial banks, that is public sector banks, private banks as well as foreign banks operating in India, may come down from 10.8% recorded in September of 2018 to 10.3% by March 2019. But this, remember, is under the baseline scenario. Things could worsen under more stress. For public sector banks, the gross NPA ratio may decline from 14.8% in September to 4.6% by March next year. And for private banks, there may be a similar decline from 3.8% in September to 3.3% by March 2019. However, there is some deterioration in capital adequacy levels of all of these banks, where RBI says there is further deterioration expected under the severe stress scenario to 12.1% by March 2019 of all scheduled commercial banks from the current level of 13.4%. This is under a severe stress scenario. A total of 9 banks, including 8 banks that are currently under the prompt corrective action regime, may have capital levels below the minimum regulatory requirement of 9% by March 2019 under the baseline scenario, and 13 banks in total may have minimum capital requirement below 9% by March 2019 under the severe stress scenario. Further, it says under the baseline scenario, the Tier 1 capital ratio could also decline from 10.4% to 10%. So capital is where the concerns remain. However, on the asset quality recognition front, it seems that the pain is coming off.
Okay, some important lines and important points outlined from the new RBI governor on the last day of the year. Thanks, Ritu, for taking us through that. Now, the Lok Sabha has passed the second batch of supplementary demands for grants for the current fiscal. The government has sought the lower houses for gross additional expenditure of 86,000 crore rupees. Now, the amount includes 41,000 crore rupees for recapitalization of public sector banks. Moving on, India and Mauritius are giving finishing touches to a landmark free trade agreement. India is seeing this deal as a gateway to African countries for Indian products, and a deal could possibly be sealed in the next few weeks itself. Ritu Padaboyan is here with the details. Ritu, when can the deal be inked?
India and Mauritius have been actually negotiating a free trade agreement for quite some time. Now, what has happened is in September this year, China signed a free trade agreement with Mauritius, and that led to more intense negotiations between India and Mauritius on the ongoing free trade agreement talks. From what we have been told, India wants to sign the free trade agreement during the visit of Mauritian Prime Minister to Delhi during the third week of January. One of the demands which has been made by Mauritius is to have zero duty access to the Indian sugar market. India has yet to agree to that. Now, this is an important FTA for India because India sees Mauritius as the stepping stone to the African market, because Mauritius and Africa have a very strong trade relationship. Mainland Africa have a very strong trade relationship, and hence many of these goods which will go to Mauritius can then be transshipped to Africa with lower duty incidence. Hence, this Mauritius FTA is important, but it remains to be seen, if both the sides, that is Mauritius and India, are able to conclude the talks and sign their free trade agreement during the visit of the Mauritian Prime Minister a little later during this month. With that, it's back to you.
Okay, Ritu, so we'll know in Jan if that deal is going to be inked. Thanks for taking us through those details. Business Hour, let's take a quick check on the other headlines that we have been tracking this evening. The revised bill to make instant triple talaq a criminal offence got stalled in the Rajya Sabha today. This as a majority of the opposition lawmakers demanded that the bill be sent to a select committee. The matter will now be taken up on the 2nd of January. The 1984 anti-Sikh riot convict Sajjan Kumar surrendered before the Karkardam, a court, to serve life imprisonment. The former Congress leader will be lodged in Delhi's Mandoli jail. Former MLAs Kishan Khokhar and Mahendra Yadav, who have also been convicted in the case, have also surrendered to serve the 10-year jail term. News from Bangladesh. Sheikh Hasina has secured a third consecutive term as the Prime Minister. Her party, the Awami League, and its allies have won a whopping 288 of the 300 parliamentary seats. The opposition has, however, blamed the ruling party of rigging. They have demanded fresh polls. But back home, Mumbai's most expensive metro project, the underground Metro Line 3, will connect Colaba to Andheri East through the commercial hub of Bandra Kurla complex when it is completed in 2021. So if you're a citizen of Mumbai, you've probably seen large sections of busy roads cordoned off with construction signs. But what's really going on beneath the surface? CNBC TV 18's Kevin Lee gets you an underground report.
Have you ever thought of your place of work as a pit of despair, a black hole, or maybe even a tunnel? I've never thought it at CNBC TV 18, but today we're literally at a tunnel where 20 people are hard at work setting up the underground line of the Mumbai Metro. That's the Mumbai Metro Line 3, which will be completed by the end of 2021. We're going to go inside this tunnel, 17 meters under the ground, to find out exactly how that work is being carried out. Follow me.
This tunnel is under Sariput Nagar in Andheri East, towards the end of the proposed Line 3, which will culminate in a car shed in RA Colony. Work on this particular tunnel began in August this year, and it's the second tunnel where digging work has been completed.
There are about 20 people currently working inside this tunnel of the Mumbai Underground Metro, but it's a bit of a walk before we get to them, so let me explain how the whole tunneling process works with some key elements that we have here. This is the most important thing. This is part of a ring. It's called a panel. There are 6 such panels in every ring. The same machine that digs the tunnel lays down these rings that form the inside of the tunnel that the metro will go in. You'll see a number over there, number 180. That's the number of this particular ring or section. There are 406 such sections in this tunnel, out of which about 340 or 350 have already been laid. This work is expected to take 1 more week to reach 406 rings or sections. Each ring takes about 35 minutes to lay in place, and it takes 1 hour to dig the tunnel deep enough for another ring to be added. You'll also see 7 distinct pipes that are under that number over there. These pipes carry a mixture of things like cold air, water, sodium silicate, which is a material which is used in the tunneling of the metro, and they also carry hot water, used air, etc. out of the tunnel as well. The big cable that you can see on top of that, this winding sort of cable, is the main power supply to the tunnel boring machine or TBM. You'll also see tracks here. Keep in mind, this is not the final metro track. This track is for smaller trains that carry sections of these rings into the tunnel and carries waste material outside the tunnel. Also, probably the most important thing, the reason that we are able to show you this is this big yellow pipe, because that's the ventilation system. It carries oxygenated air into the tunnel and takes carbon dioxide out. That's how you can have workers inside without much of a breathing problem. Now, we're going to go ahead and show you the tunnel boring machine. Follow me.
There are 17 such tunnel boring machines or TBMs being used for digging the tunnels of the Mumbai Metro Line 3. The machine digs into the ground, directed by workers inside the control panel who use a variety of equipment to direct the machine and maintain direction. Once digging has been completed for one section, the machine lays down the panels that constitute one segment or ring, which are manually bolted down. Debris is carried out of the tunnel by the same small trains that carry sections of the ring into the tunnel. The tunneling work on this particular section has been going on for close to 130 days. Once tunneling is complete, the electrified track of the metro will be laid down, and while 80% of the tunneling work of the entire Mumbai Metro route will be completed by 2019, the metro line will only be fully operational in 2021.
I'm on my way out, finally going to be above ground again. It's been such an exhausting journey just to come down here and see how these people work for a day. So spare a thought for all the workers who have been down here for years so that the city can have better infrastructure. In Mumbai, Kevin Lee.
Well, with that, it's time to wrap up this last edition of India Business Hour for the calendar year 2018. Here's wishing all our viewers a very happy and prosperous 2019. See you next year. That's, of course, tomorrow.